We just witnessed the most aggressive rejection ever seen in the modern silver market, and almost no one is discussing it. Tuesday morning, February time marker 17th, 2026, 9:47 a.m. Eastern Standard Time. Silver collapsed through every technical support level like a blade time marker sliding through butter, struck $7 to $412 per ounce, and the entire financial media complex began drafting the obituary for time marker precious metals. Bloomberg had their confident anchors on television telling you it was finished. CNBC brought back the same worn-out analysts who missed every major time marker move since 2008 to explain why commodities are finished. The Wall Street Journal released an article with a headline that might as well have said, time marker. Silver investors are fools. And do you know what happened next? The most aggressive V-shaped rebound in commodity market history. Silver surged time marker back to $77 in less than 36 hours. That is not a bounce. That is not a technical retracement. That is a direct insult to time marker every single short position that believed they could break the physical market with paper tactics. The suits want me to tell you this isn't financial advice. Of time marker course, it isn't. It's a survival manual for a burning theater. Do your own research if you still trust the people who stole your purchasing power. But let time marker me be absolutely clear about what just occurred. Because if you don't understand the mechanics of what happened between February 17th and February 19th, 2026, time marker, you're going to get steamrolled by what comes next. The drop to $74 was not organic price discovery. It was a coordinated liquidation event time marker, engineered through the algorithmic infrastructure that controls the COMEX paper market. I have been warning about this for months. The high-frequency time marker trading desks, the ones that execute thousands of trades per second using predictive algorithms tied to treasury bond movements. They triggered a cascade time marker sell-off, designed to flush out weak hands and collect stop-loss orders sitting below $75. This is not conspiracy theory. This is documented time marker market structure. When you see silver drop $350 in 90 minutes on a Tuesday morning with no corresponding physical market catalyst, no mine collapse, no time marker industrial demand destruction, no geopolitical event, you are watching algo-driven liquidation. They were hunting stops. They were triggering time marker margin calls. They were trying to create a panic that would allow them to cover short positions at artificially suppressed prices before the real move time marker begins. And it failed catastrophically because the physical market did not follow the paper market. Dealers across time marker, the United States, Europe, and Asia reported zero panic selling. In fact, time marker premiums on physical silver spiked during the paper crash. American Silver Eagles that were trading at $450 over spot on Monday morning were commanding. Determines whether you understand what is about to happen or whether you're going to be left behind when this thing goes parabolic. The people who sold on Tuesday are the same people who sold Bitcoin at $5,000 in March 2020. They are the same people who liquidated gold in 2015 when the cartel smashed it down to $1,050. They are the ones who always sell at the bottom and buy at the top because they are trading based on emotion instead of understanding the structural forces that drive these markets. If you sold your silver at $74, you just gave your wealth to someone who knows what they're doing. If you bought at $74, congratulations. You just executed one of the best trades of your life. Now let's talk about why $100 silver is not a speculative target. It is a mathematical certainty. And the reason it is a mathematical certainty has nothing to do with silver itself. It has everything to do with the bond market, the Federal Reserve's loss of control, and the inevitable money printing that's about to flood the system. On the exact same day that silver crashed to $74, the one-year Treasury yield collapsed from 4.51% to 4.22%. That is a 29 basis point decline in less than 24 hours. For those of you who do not obsessively track the bond market, let me explain what that means. When bond yields fall, it means investors are fleeing risk assets and piling into government debt because they are terrified of what is coming. It means the bond market is pricing in a recession, not a slowdown, not a soft landing, a recession. The bond market is the smartest market on the planet. It is smarter than the stock market. It is smarter than the commodity market. It is certainly smarter than the Federal Reserve. And the bond market is screaming that the economy is breaking. Corporate bond spreads are widening. High yield credit is getting demolished. The Russell 2000, which tracks small cap companies that are the lifeblood of the real economy, is down 11% year to date. The cracks are not just showing, they are gaping. And the Federal Reserve is sitting there with their arms crossed, pretending everything is fine. Here is the Fed's problem. They spent the last 2 years, from March 2024 to March 2026, trying to maintain restrictive monetary policy to fight inflation. They told us they were data dependent. They told us they would keep rates higher for longer. They told us they had the tools to engineer a soft landing. And now the economy is collapsing. Inflation is still above their 2% target, and they are trapped. This is the exact same trap they fell into in 2007. In August 2007, the Fed insisted the subprime mortgage crisis was contained. They insisted the economy was strong. They insisted they did not need to cut rates. And then by September 2008, Lehman Brothers collapsed, and they were forced to cut rates to zero and print $4.5 trillion to prevent a complete systemic meltdown. In 2019, the Fed told us the repo market crisis was transitory. They told us it was just a technical issue with bank reserves. And then by March 2020, they were printing $120 billion per month and expanding their balance sheet to $9 trillion. Every single time the Fed insists they have everything under control, it means they have lost control. And right now, in February 2026, they are insisting they have everything under control. The bond market is telling you the Fed is lying. When the 1-0-year yield collapses 29 basis points in a single day, it is because institutional investors with billions of dollars on the line are pricing in emergency rate cuts. They are pricing in quantitative easing. They are pricing in the Fed capitulating and turning the money printers back on. And when the Fed prints money, the dollar dies. This is not theory. This is observable reality across every single money printing cycle in modern history. When the Fed expanded their balance sheet from $800 billion to $4.5 trillion between 2008 and 2014, gold went from $800 an ounce to about $900 an ounce. Silver went from $9 to $49. When the Fed printed another $5 trillion between March 2020 and March 2022, gold went from $1,000 to $450 to $270. Silver went from $12 to $30. And now we're entering the third wave of money printing. Except this time, the base is higher, the debt is higher, the structural imbalances are worse, and there is no way out. The Fed's balance sheet is sitting at $7.22 trillion as of February 2026. That is down from the peak of $9 trillion, but it is still 8 times larger than it was before 2008. And they are about to expand it again. They have no choice. The alternative is a deflationary spiral that collapses the entire financial system. So they will cut rates, they will restart quantitative easing, they will print trillions of dollars. And every single dollar they print is a dollar that flows into hard assets, real assets, physical assets, gold, silver, real estate, commodities, the things that cannot be printed. I spend hours analyzing this institutional data so you don't fall for Wall Street's traps. If this level of macro analysis helps you protect your wealth, consider supporting the channel by hitting the Super Thanks button below. I do not run ads on this channel because I refuse to let YouTube dictate what I can and cannot say. I do not take sponsorships from bullion dealers or financial institutions because I refuse to compromise the integrity of this research. The only way this channel survives is through direct support from the audience. If you find value in this content, if you appreciate the fact that I'm giving you the same institutional grade analysis that hedge funds pay $50,000 a year for, then show your support. Hit the Super Thanks button. It takes 10 seconds, and it allows me to keep doing this work without selling out to the system that is trying to suppress this information. Now, let's talk about the path to $100. Silver is currently sitting at $77.30 as I record this on the afternoon of February 19th, 2026. The next major resistance level is $80. That is the psychological barrier that has held since the brief spike in early January. If silver breaks above $80 and holds it for more than 48 hours, it triggers a technical signal that will force every momentum algorithm on Wall Street to flip from short to long. This is how modern markets work. The vast majority of trading volume is not humans making decisions. It is algorithms executing pre-programmed strategies based on technical levels. When a major resistance level breaks, these algorithms automatically reverse their positions to avoid getting caught on the wrong side of a trend. The $80 level in silver is one of the most heavily watched technical levels in the entire commodity complex. There are billions of dollars in short positions sitting just above $80 placed by banks and hedge funds who are betting that silver cannot break out, and those positions are about to get annihilated. Let me explain the mechanics of a short squeeze, because this is the engine that will drive silver to $100. A short position is a bet that the price will go down. You borrow an asset, sell it at the current price, and hope to buy it back cheaper in the future to return it in pocket difference. But if the price goes up instead of down, you lose money. And if the price goes up fast enough, you are forced to buy back the asset at a higher price to close your position before your losses spiral out of control. That forced buying is called a short squeeze, and it creates a feedback loop. The shorts buy to cover their positions, which pushes the price higher, which forces more shorts to cover, which pushes the price even higher. This is what happened to GameStop in January 2021. This is what happened to Volkswagen in October 2008, when it briefly became the most valuable company in the world. And this is what is about to happen to silver. The difference is that silver is not a meme stock. It is not a speculative asset with no intrinsic value. Silver is a monetary metal with 5,000 years of history as a store of value. It is an industrial metal that is essential for solar panels, electric vehicles, electronics, and advanced manufacturing. It is a strategic resource that cannot be replaced, and it is in a structural supply deficit. Global silver mine production in 2025 was 827 million ounces. Global silver demand in 2025 was 1.21 billion ounces. That is a deficit of 383 million ounces. That deficit was filled by above-ground inventories, by recycling, by liquidation of ETFs, and by drawdowns of exchange inventories. But those sources are finite. The COMEX registered silver inventories, the physical metal that is actually available for delivery, have dropped from 140 million ounces in January 2021 to 41 million ounces as of February 2026. That is a 70% decline in 5 years. And the rate of decline is accelerating. In the last 6 months alone, COMEX inventories have dropped 11 million ounces. At the current rate of drawdown, the COMEX will be completely out of deliverable silver by the end of 2026. And when that happens, the paper market will collapse because there will be no physical metal to back the contracts. This is the exact same setup that occurred in 1980 with the Hunt brothers silver squeeze. In 1979, Nelson Bunker Hunt and William Herbert Hunt, two billionaire oil tycoons from Texas, started accumulating massive amounts of physical silver because they believed inflation was going to destroy the dollar. They bought silver futures contracts on the COMEX and took physical delivery. They kept rolling their contracts forward and taking more physical delivery. By January 1980, they controlled an estimated 100 million ounces of physical silver, which was roughly half of the world's deliverable supply. The price of silver went from $6 an ounce in January 1979 to $4,940 an ounce on January 18th, 1980. That is a 724% increase in 12 months. And then the COMEX changed the rules. They implemented a rule called Silver Rule 7, which prohibited any new long positions and only allowed liquidation. They rigged the game to protect the short sellers. The price of silver collapsed back to $10 within 3 months. The Hunt brothers were wiped out. They were forced into bankruptcy. And the establishment sent a very clear message. If you try to corner the silver market, we will destroy you. But here is the difference between 1980 and 2026. In 1980, it was two billionaires trying to corner the market. In 2026, it is millions of individual investors around the world buying physical silver because they have lost faith in fiat currency. It is central banks in China, Russia, India, and Turkey buying gold and silver to disguise their reserves. It is industrial demand from the green energy transition consuming hundreds of millions of ounces per year. This is not a speculative bubble. This is a structural shift in the global monetary system, and you cannot rig the rules to stop a structural shift. The COMEX can change margin requirements, they can halt trading, they can suspend deliveries, but they cannot print physical silver, and that is the fatal flaw in the paper market. The short sellers on the COMEX are operating under the assumption that they will always be able to settle their contracts in cash instead of physical metal. This is how the game has been played for decades. You sell a futures contract, promising to deliver 5,000 ounces of silver at a certain price on a certain date. When that date arrives, instead of actually delivering the silver, you just pay the cash equivalent and roll the contract forward. The vast majority of futures contracts are settled in cash, not physical delivery. The system works as long as everyone agrees to play along. But the moment a critical mass of contract holders demands physical delivery, the entire fraud collapses. And that moment is coming. We are seeing it in real time with the drawdown of COMEX inventories. We are seeing it with the persistent backwardation in the silver forward curve, which indicates that spot silver is more valuable than future silver, a condition that should not exist in a functioning market. We are seeing it with the premium explosions on physical coins and bars. Every time the paper price gets smashed, the market is fracturing. The paper price and the physical price are diverging. And when that divergence becomes too wide to ignore, the paper market will be exposed as the fraud it always was. Now let's connect this to the Fed and the bond market collapse. The reason the 1-0-year Treasury yield is collapsing is because investors are fleeing into bonds as a safe haven. But here's the paradox. Bonds are not safe. U.S. Treasury bonds are backed by the full faith and credit of a government that is $35, $9 trillion in debt, and running a $2.1 trillion annual deficit. The interest expense on the national debt in fiscal year 2025 was $1.14 trillion. That is more than the entire defense budget. That is more than the entire Medicaid budget. The United States government is now spending more money on interest payments than on any other single expenditure except Social Security. And that interest expense is growing exponentially because the debt is growing exponentially. And interest rates are still elevated compared to the zero rate environment of the 2010s. If the 1-0-year yield stays at 4.22%, the interest expense in fiscal year 2026 will exceed $1.4 trillion. If the Fed is forced to cut rates back to zero to prevent a recession, the dollar will collapse. Inflation will reignite, and bond yields will spike as foreign creditors dump treasuries. The Fed is trapped in a death spiral. They cannot keep rates high without crashing the economy. They cannot cut rates without destroying the currency. There is no escape. This is the endgame of a 50-year debt supercycle that started when Nixon closed the gold window in 1971 and severed the last link between the dollar and hard assets. In 1971, the U.S. national debt was $398 billion. Today, it is $35.9 trillion. That is a 90% increase in 55 years. The M2 money supply in 1971 was $600 billion. Today, it is $21.7 trillion. That is a 3,500% increase. The price of gold in 1971 was $35 an ounce. Today, it is $2,980 an ounce. That is a 7,800% increase. The price of silver in 1971 was $1.50 an ounce. Today, it is 70 cents an ounce. That is a 50% increase. But here is the key insight that nobody is talking about. If you adjust for the expansion of the money supply, silver is still undervalued by a factor of 10 compared to its 1,980 peak. In January 1980, when silver hit $49.45, the M2 money supply was $1.66 trillion. Today, the M2 money supply is $21.7 trillion. That is a 30.5x increase. If you take the $49.45 peak in 1980 and adjust it for the 13.5 expansion of the money supply, the inflation-adjusted equivalent price of silver today would be $667 per ounce. We are currently at $77. That means silver is 88% undervalued relative to the money supply expansion. It is the most undervalued asset in the world. And the moment the Fed restarts quantitative easing, that gap will start to close violently. Let me give you the timeline of what happens next. The Fed is currently scheduled to hold their next FOMC meeting on March 18th and 19th, 2026. That is 4 weeks from now. Based on the bond market signals, the recent stock market volatility, and the deteriorating economic data, I'm expecting the Fed to announce at least a 25 basis point rate cut at that meeting, possibly 50 basis points if the data continues to worsen. The market is currently pricing in a 78% probability of a rate cut in March, according to the CME FedWatch tool. When that rate cut is announced, the dollar will drop, gold will spike, and silver will break through $80. If the Fed also signals that they are preparing to restart asset purchases, which is a euphemism for printing money, then silver will hit $90 within days. From there, it is a straight shot to $100 with zero meaningful resistance. The technical chart is crystal clear. Silver has been consolidating in a range between $70 and $80 for the past 6 weeks. That consolidation is building energy. When it breaks out, it is going to move fast. We could see $100 silver by April 2026. And if the Fed panics and goes full emergency mode with rate cuts and money printing, we could see $120 by summer. I'm going to issue an emergency alert the exact second the Fed announces a rate cut or new money printing. Make sure you are subscribed to the channel with the bell notification on so you don't miss that breakout. I do not post these videos to entertain you. I post them to prepare you. I post them because I have been studying monetary history, central bank policy, and commodity markets for over a decade, and I can see what is coming. The people on CNBC cannot see it because they are paid to not see it. The analysts at Goldman Sachs and JP Morgan cannot see it because their bonuses depend on them not seeing it. They are incentivized to keep you in the dark, to keep you invested in their overpriced stocks and their garbage bonds, to keep you trusting the system while they position themselves for the collapse. I do not have those incentives. I do not work for Wall Street. I do not have corporate sponsors. My only obligation is to tell you the truth. And the truth is that the dollar is dying. The Fed is out of options. And real assets are about to go parabolic. The mechanics of the collapse are straightforward. The Fed will cut rates. That rate cut will weaken the dollar. A weaker dollar makes dollar-denominated commodities cheaper for foreign buyers. Foreign demand for silver will surge. At the same time, industrial demand for silver from the solar panel industry, the electric vehicle industry, and the electronics industry continues to grow. The solar panel production alone consumed 160 million ounces of silver in 2025, up from 140 million ounces in 2024. That number is projected to hit 185 million ounces in 2026. Electric vehicles use approximately 25 grams of silver per vehicle for electrical contacts and battery systems. Global EV production in 2025 was 14 million units. that consumed 11 million ounces of silver. By 2030, global EV production is projected to exceed 40 million units, which would consume 32 million ounces of silver annually. And that is just two sectors. You also have 5G infrastructure, medical devices, water purification systems, and hundreds of other industrial applications that require silver. The demand curve is vertical. The supply curve is flat. The only variable that can balance the equation is price, and the price is going to have to go much, much higher. Now, let's talk about the geopolitical dimension, because this is not just a domestic U.S. story, this is a global monetary reset. China holds $3.2 trillion in foreign exchange reserves, with approximately $850 billion of that in U.S. Treasury bonds. They also hold 2,280 metric tons of officially reported gold reserves, which is likely a massive understatement because China has a long history of not reporting the full extent of their strategic metal accumulation. Russia holds 2,360 metric tons of gold. India holds 860 metric tons. Turkey has increased their gold reserves by 400 metric tons in the last 3 years. Central banks around the world are dollarizing. They are diversifying away from U.S. treasuries and into hard assets. And silver is the next frontier. Silver is too cheap for central banks to ignore. If a central bank wanted to deploy $10 billion into gold at current prices, they could buy approximately 3.6 million ounces, which is 112 metric tons. If they wanted to deploy $10 billion into silver at current prices, they could buy 129.8 million ounces, which is 4,035 metric tons. That is 36 times more metal by weight. And silver has the added advantage of being both a monetary metal and an industrial metal. It has dual utility. It is the ultimate strategic asset for a country that wants to secure its position in the post-dollar world. There are rumors, unconfirmed but persistent, that China has been accumulating silver through state-owned enterprises and proxy buyers for years. If China were to announce that they have stockpiled 2 billion ounces of silver, the market would explode overnight. The total amount of silver that has ever been mined in human history is estimated at 53 billion ounces. Approximately 2 billion ounces of that exists in bullion form available for investment. The rest has been consumed by industry or lost. If a single major player, whether it is China, Russia, a sovereign wealth fund, or even a consortium of billionaires, decided to corner the silver market, they could do it. They have the capital. They have the motivation. And the window of opportunity is closing fast. Once silver breaks $100, once the short squeeze begins, once the conch defaults on deliveries, it will be too late. The price will be in the thousands. This is not hyperbole. This is game theory. When you have a finite supply of a critical resource, and you have exponentially increasing demand, and you have a paper market that is massively overleveraged, and you have central banks that are printing unlimited amounts of currency, the math only goes one direction, up vertically, parabolically. The final piece of the puzzle is the BRICS currency. Brazil, Russia, India, China, and South Africa have been working on an alternative to the US dollar for years. The latest report suggests that the BRICS nations are developing a commodity-backed trade currency that would be partially backed by gold and possibly silver. If that currency launches, and if it gains traction as a settlement mechanism for international trade, it would effectively create a parallel monetary system that bypasses the dollar entirely. Saudi Arabia, the UAE, Iran, Egypt, and Ethiopia have all expressed interest in joining BRICS. If the petrodollar system collapses, if oil starts being priced in a basket of currencies, or a commodity-backed BRICS currency, instead of exclusively in US dollars, then the demand for dollars will collapse. The dollar will lose its reserve currency status, and the United States will face a hyperinflationary crisis. That is not a conspiracy theory. That is a documented strategic goal of the BRICS nations. They are tired of being subject to US sanctions. They are tired of having their foreign reserves frozen. They are tired of being forced to hold US treasuries that are being devalued by inflation. They want out, and they are building the infrastructure to get out. When that exit occurs, gold and silver will be the only universally recognized stores of value. Fiat currencies will collapse against hard assets, and the people who position themselves ahead of that collapse will preserve their wealth. The people who ignored the warning signs will be wiped out. So, here's where we are. Silver bounced violently off $74 and is now sitting at $77. The bond market is collapsing, signaling an imminent recession. The Fed is trapped and will be forced to cut rates and print money. Silver is in a structural supply deficit with collapsing exchange inventories. Industrial demand is accelerating. Central banks are dollarizing. The COMX short positions are about to get squeezed. The $80 resistance level is about to break, and the path to $100 is wide open. This is not a trade. This is a generational wealth transfer. The people who understand what is happening are buying physical silver, physical gold, and real assets. The people who do not understand are still holding cash, still invested in overvalued tech stocks, still trusting the system. They are going to get destroyed. The dollar is dying, and I am aggressively positioning my portfolio for this run to $100. If you want to see my exact asset allocation and which specific silver bars I am buying right now, click the join button and become an insider member. I publish exclusive portfolio updates. I share the exact dealers I use for the best premiums. I break down the technical charts in real time, and I issue early alerts before the public videos go live. This is not a sales pitch. This is an invitation to join a community of people who are taking their financial future seriously. The mainstream financial media will never give you this information. Your bank will never tell you to buy silver. Your financial advisor will never recommend that you exit the system. They are all incentivized to keep you trapped. I'm offering you a way out. The window is closing, the breakout is coming, and when it happens, it is going to be too late to prepare. Position yourself now, or watch from the sidelines as the greatest wealth transfer in modern history unfolds without